Hello, everyone. Today, we're going to discuss Chapter 12, Cost of Capital. First of all, let's have a review of cost of capital. Until now, we have learned how to estimate the present value, how to estimate the value of an asset such as a stock, a bond. When we are doing this, we use a discount rate to discount the future cash flows that an asset will produce into the present value. Then how can we discount? How can we determine the discount rate? We know the discount rate is the return that investor requires to receive on the asset, right? So from the viewpoint of investors, we know that investors require a return on an asset depending on the risk of the asset. We know that investors require a return on an asset depending on the risk of the asset. That is the risk return trade-off principle, right? Okay. In this chapter, we are still looking at this required rate of return on an asset. However, we are not looking at from an investor's perspective. Now, we are looking at this required rate of return from a viewpoint of the firms. From the viewpoint of the firms, the return required by investors is the cost for a company to use the capital for capital funding. When a firm, raise money, then they have to pay a minimum of return to the investors, so that investors are willing to purchase the firm's financial instruments such as stocks and bonds right? So from the viewpoint of the firm, that this is the cost that the firm must pay to the investors so that they are able to use the funds raised from the investors. If they don't pay this minimum cost, then investors would not buy their their financial assets. Okay. So in this sense, the cost of capital funding to a firm is the same as the return required by the providers of the funds. Generally speaking, this is the two sides of one coin. They are the same. Essentially they are the same thing. From the viewpoint of investors, they are the required return. Okay, from the viewpoint of firms, they are the cost of capital that the company has to pay to use the funds raised from the investors. So in this chapter, we're going to look at we're going to look at this required rate of return from the viewpoint of the firms. Why cost of capital is so important? Why do we learn this? There are 3 points. A firm must earn at least the required return to compensate investors for the financing they have provided. Okay, that is the minimum return the firm has to produce. A firm has to produce so that they can attract investors to provide the funds. because the return required on assets depends on the risk of those assets, then the firm's cost of capital indicates how the market views the risk of the firm's assets. Yeah, we have learned the risk return trade-off principle, right? The return, the required return is always associated with the level of the risk that an investor will take on. Now, from the perspective of firms, the firm's cost of capital shows the market view on the risk of the firm's assets. Okay. Then the third point, since the required return is used as discount rate to calculate the present value, estimating the cost of capital can also help us determine the discount rate for capital budgeting. Okay, so this is very important in the capital budgeting. In the capital budgeting. Because in the capital budgeting, we have to determine the discount rate, right? Discount rate, and in this sense, the discount rate, is the cost of the capital. Okay, in this chapter, we're going to use these terminologies, such as expected return, or required return, required rate of return, or appropriate discount rate or discount rate, and the capital cost of capital. These three terms are interchangeable. Okay, just as I said, we use them. We use a term under different circumstances. If we want to look at, from the perspective of a firm, then we use the cost of capital. If we look at from the perspective of an investor, then we use expected return. When we in the capital budgeting, we want to discount the future cash flows into the present value, then we use the discount rate. Okay. Generally speaking, these three terms are interchangeable. Before we move on, I like to emphasize an important point. The cost of capital associated with an investment depends on the risk of its investment. Okay, that is the risk return principle. Okay, if the company has a higher risk, then the company will pay a higher cost of capital. Okay. Then also the cost of capital depends primarily on the use of the funds, not the sources. If some dollars are used as equity, then we determine the cost of equity based on the risk of equity. If some dollars are used in debt, then we determine the cost of debt based on the risk of the debt. Of course, the equity and the debt have different risk, right? Until now, we know, the debt has much smaller risk than equity. The debt, if you lend money to a company, the company promises to pay the interest rate and return the principals. Okay, and however, if you invest, if you invest in a company as an equity holder, then you are the residuals claimer. Yeah, that means if a company makes money, then you can receive dividends. Otherwise, if company is losing money, you may lose your investment. So of course, equity has a higher risk than the debt. Okay, then in this case, we would like to say the cost of equity would be higher than the cost of debt. Okay, now let's look at the cost of equity. Yeah, how can we estimate the cost of equity? The cost of equity is the return required by equity investors given the risk of the cash flows from the firm's equity. So what is the cash flows from the firm's equity? What kind of cash flows does an equity holder receive? Of course, is dividends and or the capital of the capital gains, right? Capital gains. So the cost of equity depends on the risk of dividends plus the capital gains. Then there are two major methods for determining the cost of equity. Yeah, until now, we have learned the dividend growth model, right? And we can use the dividend growth model to estimate the price of a stock. Also, we can use dividend growth model to estimate the risk of equity. Okay, and also, in chapter 11, we just finished, we have learned the capital asset pricing model. Also, we can use CAPAIN to estimate the cost of equity. Now, first of all, let's look at the dividend growth model. We start with the dividend growth model formula. So that is, I believe, you can remember the dividend growth model formula. P0, that is the price of a stock at the beginning of a period, okay, equals D0. D0 represents the dividends that was just issued, okay, then times 1 plus G. Here, G is the growth rate of the dividends. We suppose in the future, in the infinite future, dividend will be growing at a constant rate of G, then divided by RE. That is, RE represents the the cost of equity, the cost of equity, or the required rate of return of equity, that minus G. Now we can rearrange. Now in this formula, we can observe P0. We can observe D0. We can use historical data to estimate the constant dividend growth rate. Okay, and then we can then in this case, in this formula, the only unknown is RE. The only unknown is RE. So we can rearrange this equation to solve for RE. Then we get the formula to calculate RE. Here it is the formula to calculate the RE. Okay, RE equals D0 times 1 plus G divided by P0, then plus G. So that is the cost of equity. Cost of equity. Now let's look at an example. Your company is expected to pay a dividend of $4.40 per share next year. Okay, next year. I use the notation dividend one. Now you have to be careful. Okay, you have to be careful. Here the information about the dividend is the dividend you expect to receive, yeah, in the coming period. Okay, that is D1. Okay, then dividends have grown at a steady rate of 5.1% per year, and the market expects that to continue. Yeah, it expects dividend will continue at a constant rate G. The current stock price is $50. That is P0. Now, what is the cost of equity? That means what is the required rate of return of equity, right? Okay, then we can use formula. In this case, yeah, we know the dividend growth model, right? P0, RE equals D0 times 1 plus G over P0 plus G. Now we know D0 times 1 plus G equals what? Equals D1, right? We already know this. Okay, then in this case, yeah, in our example, do we know 1? Yes, we know 1. Do we know dividend 1? We know dividend 1. So in this case, the formula could be RE equals D1 over P0 plus G, right? Okay, then what is D1? $4.40 divided by P0, $50. Then plus G. G is 5.1%. Okay, be careful. In this case, G should be in percentage, right? Should be in percentage. In percentage, that is 0.051. Okay, now we can get the results. That is 0.139. In percentage, that is 13.9%. Okay, so the answer is the cost of equity is 13.9%. Yeah, 13.9%. So yeah, if you buy this stock, you require you require to receive 13.9%. Because you require to receive 13.9% return, then the company has to pay 13.9% return to you. Then that is the cost of equity that company has to pay to use your dollar. Okay. Otherwise, you would not buy this stock, and the company will not get money from you, right? Okay. Of course, now, yeah, if we use dividend growth model, just as I said, right? Just as I said, the P0, yeah, we use the formula. P0 is observable. D0 is observable. Now the point is how to estimate the dividend growth rate. We can use historical data to estimate the dividend growth rate. Now let's look at this example, estimating the dividend growth rate. One method for estimating the dividend growth rate is to use the historical average. For example, for one stock, I have observed 5 consecutive years from 2003 to 2007. Okay, for the sake of simplicity, I assume that dividend has been issued on yearly basis, okay, or at the end of each year. Now, I have observed the 2003 dividend is $1.23, and 2004 dividend $1.30, and on and on. Okay, the number is listed in this column. Okay, now we can calculate the percentage change, right? We can calculate the yearly growth rate. Okay, for 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 year 2004, of course, yeah, the growth rate is the now, yeah, we are calculating the growth rate, right? So that should be ending value, 2004 dividends minus the beginning value, 2003 dividends divided by the beginning value, right? Beginning value, 2003 dividends. Then we can get this number. Okay, I show this number in percentage. That is 5.7%. I do the same thing for 2005. For 2005, okay, for 2005, ending value of 2005 dividend $1.36 minus the beginning value, that is 2004 dividend $1.30, then divided by the beginning value 2004 dividends, then I can get the number. Okay, anyway, I did the same thing for each year. Then I get the dividend growth rate from 2004 to 2007. Then I take an average this 4-year dividend growth rate. Okay, 5.7, 2004's dividend growth rate plus 4.6, 2005 dividend growth rate, then plus 5.1, that is 2006 dividend growth rate, then plus 4.9, that is 2007 dividend growth rate, and then divided by the number of years, then we can get 5.1%. Okay, that is as a matter of fact, 5.1%, 5.1 is the average dividend growth rate in the past 4 years, right? In the past 4 years, okay? And we use this average dividend growth rate to proxy for the future dividend growth rate. Yeah, we assume in the future dividend will be growing at the same rate. Okay, and this rate can be proxied. Yeah, is this rate this can be estimated with the historical average growth rate. Of course, yeah. Of course, in this case, the 5.1% does not exactly to predict the future. So sometimes when you estimate the future cost of capital, you have to make an adjustment for the estimated dividend growth rate. Okay, based on your prediction of the future. Okay, if you predict, yeah, in the future dividend may be growing a little bit faster, then you can use 5.2% or 5.25%. If you predict in the future dividend may be slowing down, then you can use 5%. Okay, so anyway, this is one point that I like to emphasize. Okay, after we use the historical average, we cannot simply apply this historical average to predict the future dividend growth rate. We have to make an adjustment based on our prediction about the future. Okay, now let's look at the advantages and disadvantages of dividend growth model. Advantage, it is easy to understand and use, right? Yeah, it is easy for us. It is easy for us to observe the price, to observe the dividend. And also it is easy for us to estimate the dividend growth rate. And the disadvantage, first of all, this dividend growth model is only applicable to companies currently paying dividends. In the real world, some companies do not pay dividends. For example, the Amazon, right? Yeah, if you look at the records, the historical records of Amazon, then you can find that Amazon seldom pays dividends to their shareholders. Then in this case, there is no dividend data. Then does this mean that Amazon will not be growing, or does that mean that the Amazon's dividends will not be growing? Of course not. Of course not. Okay. Then in this case, the dividend growth model is not applicable. Okay. Then the second point of disadvantage is not applicable if dividends aren't growing at a reasonable constant rate, just as I said, right? We assume dividend will be growing at a constant rate. But anyway, in the future, there are some ups and downs. Okay, then if the ups and downs are too large, then this model is not applicable. In my opinion, the largest disadvantage is this model is very sensitive to the estimated growth rate. Okay, now we can see, right? Yeah, if we look at the model, now we can see the RE equals the D1 over P0 plus G, right? Now we can see an increase in G of 1% increases the cost of equity by 1%. Okay, so that means the cost of capital is very sensitive to the estimated growth rate. However, yeah, it is very difficult to accurately estimate the growth rate. Okay, so this is a disadvantage. And the last disadvantage is this model does not explicitly consider the risk. Yeah, always we say risk return trade-off principle. However, in this model, it does not explicitly consider the risk. How risk affects the cost of capital from this model, we cannot see, right? So that those are the disadvantages of dividend growth model. Because of those disadvantages, then we're going to try the campaign approach or capital asset pricing model. We can use capital asset pricing model to estimate the discount, to estimate the required rate of return. Okay, yeah, we have this formula. We have this formula. In this formula, I use RE to represent the cost of equity. And then we know, okay, yeah, in Japan, it equals RF. RF is risk-free rate. Yeah, we speak of risk-free rate very often. Yeah, we know risk-free rate is a compensation for yielding the current consumption in exchange for the more future consumption, right? And then plus beta E. Beta E is the systematic risk of equity. Okay, systematic risk of equity, and times ERM. This is expected market return, right? Minus RF we know that is risk-free rate. So expected return on market portfolio minus risk-free rate. Then in the parentheses, it is nothing but the market risk premium. Okay, so now we know, yeah, based on Japan model, if we know the risk-free rate, if we can estimate the beta of equity or systematic risk of equity, and if we know the market risk premium, then we can use this formula or Japan to estimate the required rate of return, right? Yeah, just now, that in the chapter 11, we know Japan establishes a quantitative relationship between the expected return and its and assets systematic risk, right? So if we can estimate the systematic risk of an asset, then we can estimate, yeah, we can find out its required rate of return. This required rate of return is nothing but the cost of equity. Okay. Now in the real world, of course, this one can be observed, right? Risk-free rate can be observed, and market portfolios expected return can be estimated. Okay, and then beta of equity, the systematic risk of an equity can be estimated because these variables can be estimated with historical data. Then we can estimate it. The cost of equity. Okay, now let's look at an example. Now we know company's equity beta is 1.2. What does 1.2 mean? That means that this company's equity has a higher systematic return than the market portfolio, right? We know market portfolio. We know the beta of market portfolio is 1. Okay. Now, current risk-free rate is 7%. Expected market risk premium is 6%. Then what is the cost of equity capital? Okay, yeah, in our course, yeah, these numbers or this information will be provided. Okay, however, in the real world, yeah, this number, yeah, company's equity beta, current risk-free rate, expected market risk premium should be estimated from historical data. Okay, from historical data. After we estimated these numbers, also we have to make an adjustment of these numbers based on our prediction about the future. But anyway, in this course, we assume these numbers have been estimated. What we are going to do is just use this estimated number to calculate the cost of equity. Okay, now we're going to use campaign. We're going to use campaign. If we use campaign, then we know campaign is a risk-free rate. What is a risk-free rate? Risk-free rate is 7%. Okay, here in this formula, I use percent. Okay, 7% plus beta of company. Beta is 1.2. Okay, beta is this one. And times expected market risk premium. Okay, that is 6%. That is 6%. Okay. Okay. Times market risk premium. Market risk premium should be expected return, market portfolio minus risk-free rate. Minus risk-free rate. Right? But that is 6%. And that is 6%. Okay. And if we do the calculation, we get 14.2%. Here, yeah, I like to point out in this situation, I use a percentage, right? The return is expressed as percentage. Of course, if you use the decimal, you can get the same result. Yeah, you can get the same result. Also, I like to point out the campaign is one of a few formulas in which you can use percent. Yeah, you can use percentage. Yeah, you can use percentage to measure the return. Okay, generally speaking, yeah, or to be safe, I suggest you to use decimal to express the return. And then after you get the result, you convert the decimal result into percentage. However, campaign is one of a few cases, yeah, in which you can use percentage to show the return and get the result in percentage. Okay. All right. Now, if we use campaign, what is the advantage and what are disadvantage? Of course, advantage, campaign explicitly adjusts for systematic risk, right? Yeah, we already know there is a quantitative relationship between expected return and systematic risk. Okay. And this quantitative relationship is shown in beta, right? It's shown in beta. If we write a campaign, we know expected return equals risk-free rate plus beta times market risk premium. That is market risk premium. Okay, now we can see. Okay, if beta is 1, what does this mean? That means when market risk premium increases, okay, let's say, yeah, when beta is, yeah, in previous example, beta is 1.2, right? Yeah, now let's use 1.2. Okay, now we know if market risk premium increases by 1%, okay, that is market risk premium, Now we know. Okay, if this one is market risk premium. If market risk premium increases by 1%, what happened to the expected return of this asset? Of course, the return of this asset increases by 1.2%, right? Okay. Now, disadvantage. Japan has some disadvantages. First of all, we must estimate the expected market risk premium, right? Yeah. Which does vary over time. Yeah, we have to use historical data to estimate expected market risk premium. However, yeah, this premium varies over time. Also, we have to estimate the beta. Okay, beta is not stable either. And this model or campaign relies on the past to predict the future, okay, which is not always reliable. Just anyway, yeah, when we use historical to predict the future, it is not completely reliable. Okay, then in this case, yeah, we have to make an adjustment based on our prediction about the future. So that is advantages and disadvantages. Now let's look at an example. For a company's equity, we know this information. Yeah, we know the company's beta, that is 1.5. Okay. Also, yeah, we have observed, or we have estimated the market risk premium, that is 9%. Okay, that is 9%. Okay. And also we know, yeah, we know the current risk rate is 6%. Okay, then in this case, before we move on, yeah, I'd like to ask you a question. Then what is the expected return on the market portfolio? That means what is expected return on market portfolio? Of course, yeah, it should be risk-free rate plus the market risk premium, right? Plus market risk premium. So it is risk-free rate 6% plus market risk premium 9%. Then that is 15%. So expected return of market portfolio is 15%, right? Okay. Now also we know. Analysts estimates of growth rate 6% per year. That means, yeah, the dividend will be growing at a constant rate 6%. The last dividend paid 2%, $2. And the current stock price $15.65. Okay. First of all, we use campaign to estimate. We use campaign to estimate the cost of equity. If we use campaign, that, yeah, I use RE to represent the cost of equity. Use RE. Okay, that should be risk-free rate. Risk-free rate is 6%, right? Times beta 1.5%. Plus, okay, yeah, that is risk-free rate plus beta times market risk premium. What is market risk premium? That is 9%. 9%. Okay, then we get the cost of equity. That is 19.5%. Okay, is this number, right? This number. So that is the cost of equity estimated from campaign. Now let's use dividend growth model. If we use dividend growth model, then we have RE, cost of capital, equals dividend zero. What is dividend zero? Dividend zero is here, $2, right? Dividend zero times 1 plus G. What is G? G is 6%. Okay, be careful. Yeah, in this case, we have to use a decimal. Right? We have to use decimal. That is that is 1 plus 0.06, right? That is the number in the numerator. Dividend zero times 1 plus G. G is 0.06. Okay, then divided by the P0. What is P0? Current price, $15.65. Okay, $15.65. Then plus G, of course, G is 6% in decimal, so that should be 0.06. Then we can get 19.55%. Okay. In the real world, if we want to use the cost of capital, we usually use several different methods. Okay. Here, we have learned the campaign. We have learned the dividend growth model. In the real world, there are some other methods. Anyway, we are going to use a couple of different methods. If the results are convergent, if the results are close to each other, then we would be confident to say, okay, this estimation is accurate. Okay, if results are divergent, then we have we should be careful when we use the cost of equity to estimate the to do something. Okay, so that is the part one of chapter 12.